Have you ever wondered whether a reverse mortgage or HELOC is a better choice for accessing home equity? The answer might surprise you, and it all comes down to what works best for your goals. Hey, I'm Emmett Dempsey, a licensed mortgage broker here in Florida, and I help families get loans each and every day, not just talk about them on YouTube. My mother needed a financial solution in her later years, so I helped her get a reverse mortgage. It was a game changer for her. Today we're diving into the key differences between reverse mortgages and HELOCs. By the end of the video, you know which option to choose, and it will help you make the best decision for your financial future. So let's get started. A reverse mortgage is a financial tool for homeowners age 62 and older. It lets them access their home equity without making monthly mortgage payment. A reverse mortgage works in reverse. You do not borrow money and pay it back over time as with a traditional loan. The lender pays you instead of you paying them. You repay the loan only when you sell the home, move out, or pass away. Retirees often use this type of loan to get extra income. They need to cover living expenses, pay off debt, or handle surprise costs like medical bills. One of its key benefits is flexibility. Borrowers can take the money as a lump sum, monthly payments, or as a line of credit. They can draw it as needed. For many, it brings peace of mind. They can stay in their home and access their hard-earned equity. It's important to note that with a reverse mortgage, you still retain ownership of your home. That means you're still responsible for property tax, homeowners insurance, and maintenance. But unlike what some critics claim, you're not signing your house to the bank. Instead, it's a way to leverage your home's value and improve your quality of life. I've seen firsthand how beneficial this loan can be. A reverse mortgage gave my mother financial freedom in her retirement. I let her stay in the home that she loved, and it's a tool. It's often misunderstood, guys, and it can be a very powerful one when used in the right circumstances. A home equity line of credit, or HELOC, is a way to access your home equity, but it works in a way that is clearly different from a reverse mortgage. Think of a HELOC like a credit card. It's tied to the equity in your home. You're approved for a specific amount of credit. You can use it as needed during the draw period, which lasts 5 to 10 years. During this time, you may only need to make interest payments on what you borrowed. HELOCs are often used by homeowners who need flexibility. For example, a HELOC lets you borrow what you need, when you need it. It's useful for major home renovation, college tuition, or unexpected expense. However, once the draw period ends, the repayment phase begins. You need to start repaying both the principal and interest. This means often higher monthly payments. One of the biggest advantages of a HELOC is its lower upfront cost compared to a reverse mortgage. However, there are some trade-offs. HELOCs usually have a variable interest rate, so your payment can increase if rates rise. Unlike a reverse mortgage, you must make monthly payments from the start. This can add financial pressure if your income is tight. HELOCs are a great tool for homeowners who want flexible access to their equity, but they require a steady income and good credit to qualify. This makes them a less practical choice for retirees living on a fixed income. It's a good option for many, but weigh the risk and benefits based on your financial situation. Now that we covered the basics of reverse mortgages and HELOCs, let's compare them. We'll look at the eligibility, repayment, flexibility, and costs. Understanding these differences is crucial in determining which option is best for you. A reverse mortgage is for homeowners age 62 and older. It's popular with retirees. The loan is based on your home's equity and your age, so there's no need for steady income or high credit score. A HELOC, in contrast, needs good credit and enough income to qualify. Lenders, they want to ensure you can handle the monthly payments. This makes HELOCs more accessible to younger homeowners who are still working. This is one of the most significant differences between the two. A reverse mortgage requires no monthly payments if you live in the home. It's a low-stress option for retirees on a fixed income. The loan is repaid only when the home is sold, you move out, or you pass away. A HELOC, on the other hand, requires monthly payments from the moment that you borrow it. You start with interest-only payments during the draw period, then you switch to full principal and interest payments during the repayment phase. This repayment structure can become a burden if your income falls or your expenses rise. When it comes to flexibility, a HELOC has the edge. It works like a credit line. You can borrow as much or as little as you need during the draw period up to your limit. Reverse mortgages are less flexible. You must choose how to receive the funds at the time of the loan origination. You can't pick a lump sum, monthly payments, or a line of credit. Reverse mortgages have higher upfront costs. These include origination fees, mortgage insurance, and closing costs. But these are often rolled into the loan. Reverse mortgages have higher costs, as I've noted in other videos. It's due to how they calculate costs, guys. For instance, here in Florida, we have doc stamps on the loan amount and title insurance as well. But on a reverse, the appraised value serves as a basis for those fees versus the loan amount. So the fees are higher due to the mortgage rules, not because reverse mortgages are more expensive. HELOC has lower upfront costs, but variable interest rates can rise. This may increase your costs over time. In the end, the choice between a reverse mortgage and a HELOC will depend on your financial goals and situation. If you're retired or close to it, a reverse mortgage can help. It provides income without the stress of monthly payments, or if you're still working and want a flexible option for funding projects or expenses, a HELOC might be a better fit. It's all about what works best for your life and your finances. We've covered the basics and then compared reverse mortgages and HELOCs. Now, let's look at their pros and cons. This will give you a clearer view of each option. A key benefit of a reverse mortgage is no monthly payments. For retirees on a fixed income, this can be a game changer. It frees up cash for other essential expenses. You can also choose how to receive the funds. Options include a lump sum, monthly income, or a line of credit. This adds some flexibility based on your financial needs. Another pro is that the federal government insures the loan through HUD. This means protections are in place for you. You'll never owe more than the home's value when the loan is repaid because it's a non-recourse loan. You do have high upfront costs. These include origination fees, mortgage insurance, and closing costs. These are usually rolled into the loan but can eat into your home's equity. As the loan balance increases with accruing interest, there also may be less equity for heirs. It's also vital to keep up with your taxes, insurance, and maintenance to avoid defaulting on the loan. HELOCs do offer a level of flexibility that reverse mortgages just can't match. You can borrow only what you need during the draw period, so they are great for projects and uncertain costs like home renovations. They have lower upfront costs than reverse mortgages do as well. During the draw period, you may be able to make interest-only payments. This can keep initial monthly expenses very low. But the biggest downside is the need to make monthly payments. They might start only with interest-only payments, but once the repayment phase begins, the payments rise sharply. Also, HELOCs often have variable interest rates. If rates rise, your payments could go up. Keep this in mind in today's volatile rate environment. Lastly, a HELOC needs strong credit score and steady income to qualify, so it's less accessible for retirees and those with unstable finances. Both options have pros and cons. The right choice depends on your financial goals, your age, and how you will use the funds. A reverse mortgage is best for retirees. Lets them access their home equity without monthly payments. A HELOC is better for younger homeowners needing flexible access to funds. Understanding these pros and cons will help you make an informed decision. Let's use a couple of examples to show how a reverse mortgage or HELOC might work for you. Meet Susan, a 68-year-old retiree. She lives in her home for 30 years. She gets a fixed income from Social Security and a small pension. But rising medical costs and inflation are straining her budget. Susan doesn't want to sell the home, but she needs extra income to maintain her lifestyle. A reverse mortgage lets Susan use her home equity now. She can get monthly payments without repaying a loan each month. The solution covers her expenses and lets her stay in her home and keep her independence. Now let's talk about Alex and Jamie. They're a couple in their 40s. They've lived in their home for 5 years and they've built up enough equity. Now they plan a big renovation to add a bedroom and update their kitchen. They want the flexibility to borrow only what they need as the project progresses. A HELOC is perfect. It gives a credit line for the renovation that they can draw upon from as they need it. Also, they both work and have strong credit, so they can handle the monthly payments. Take John, a 72-year-old widower. He wants to downsize in a few years, but he needs cash flow now from home repairs and travel. John offers a reverse mortgage line of credit, which he can draw from as he needed. He gives him financial flexibility now, but he plans to sell the home later, so he will pay the loan when he sells the house. These scenarios show how financial goals and life stages align with the two products. If, like Susan, you want to boost your retirement income, consider a reverse mortgage. It could be a great solution. If you're like Alex and Jamie and need flexible access to funds for a project, a HELOC may be a better fit. If, like John, you need flexibility to sell your home, a reverse mortgage line of credit might be perfect. Your situation and goals will guide the best choice for you. Now that you've learned about reverse mortgages and HELOCs, you're closer to deciding what's best for your finances. But you might not know this. There is a new type of reverse mortgage. It acts as a second mortgage and lets you keep your low-rate first mortgage, and it's called the Home Safe Second. It could be a game changer for homeowners seeking flexible, strong access to their equity. Want to know more? Go and click on this video to learn all about the Home Safe Second and how it might work for you.